Hi, John Carter here for part 3 of Invest in Yourself. Today we're going to talk about setting up the right business structure. And there are several different business structures that you can do. The most common one that most people do is called a sole proprietorship. What a sole proprietorship is that you own the business, it's just you, and all of the money that you make goes into your personal account. And a sole proprietorship is set up under your social security number. The problem with sole proprietorships is that all of the liability of that business falls on you personally. So if someone sues you, you can lose everything because whatever's in your name, your house, your car, your bank accounts, they can attach those things if you have a sole proprietorship. What would be better than a sole proprietorship is to limit your liability. Sole proprietorships don't give you a lot of options when it comes to setting up businesses as far as setting up a DUNS number, setting up a business that's separate from yourself to protect yourself from certain types of liabilities. So let's talk about some of those other structures other than sole proprietorships. Sole proprietorships also, when they file taxes, they file a Schedule C, which is filed with their regular tax return. Nothing wrong with them. It's just that if you are concerned about liability issues, a sole proprietorship is probably not the way to go. There are a lot of home daycare centers that are set up as sole proprietorships, which is a mistake because if someone in that center or that you're running as a sole proprietorship does something, then the liability also falls on you and that center. And so if a person gets tagged with abusing a child or not doing something properly or mishandling Title 20 money, then you also will not be able to continue to run that business, and you may be barred from certain things over a period of years because of the type of structure that you had that business set up under. So let's talk about joint ventures. Husband and wives also can run sole proprietorships, but it's better to set it up as a joint venture because if you set your business up as a joint venture, then what happens is that you and your wife will sign an agreement, or you and your partner, whoever it is, can sign an agreement, but it limits your liability. You can limit that liability, but in a joint venture, the money still gets taxed to you, and the liability still gets taxed to both of you or whoever your partners are personally. The other type of entity to set up is a limited liability company. A limited liability companies, those are fairly new in most jurisdictions, but it means just that, limited liability. Limited liability companies have members, but they are a pass-through organization. So the money that you make, the person writes a check out to the name of the business, it goes into the account, but that money is not taxed when it's written to the company and it goes into the company account. That money is only taxed when it's distributed to the members of that organization as income. So setting up a limited liability company not only gives you a better tax break and a better tax incentive, but it also limits your liability that if someone sues you. A limited liability company is its own legal entity. It's like it's being its own person. So limited liability companies are very attractive to set up for a person in a small business because you can be a single member LLC, which means that the money that you make still comes to you, but you need to take an election to file either an 1120S or a partnership return as a limited liability company. Otherwise, the IRS will regard it as a disregarded entity. And then if it does that, you'll still be filing a Schedule C. However, because you set it up legally in your state as a limited liability company, your liability for the assets or the liabilities or whatever of that company are limited. Let's talk about partnerships. Partnerships are when you have two or more people that are engaged in a business and they're going to share the profits, the overall profits of that business. However, just like a limited liability company, a partnership is a pass-through. So the money isn't taxed when you get it and it goes into the actual account for the partnership, but the money will be taxed as it's distributed. So each partner will get a Schedule K1 at the end of the tax year, and the money that they are actually distributed or that's dispensed to them is what's actually taxed. But the partnership pays just like the limited liability company for the debts and the liabilities of the company itself, but that offers you much more protection. Not as much as a limited liability company, but it still offers protection over a sole proprietorship. The next one is a subchapter S corporation. Subchapter S corporations, and a lot of people will incorporate themselves, but the problems with corporations, subchapter S and C corporations, is that they are not pass-through organizations. A corporation is going to be taxed just like the individual members are going to be taxed. So if you set up a corporation or you incorporate yourself for your business, you're going to be taxed twice. So when the income comes into the corporation, it has to file an 1120 or 1120S. That money that comes in is taxed, and then when it's distributed to the board members or the shareholders or however you do it as income, the money is taxed again. But there again, the liability is limited in a corporation as far as asset protection, but not as much as a limited liability company, because the IRS and other entities can actually pierce the corporate veil if you do not conduct your business properly as a corporation. And if you are a corporation, but you don't keep your proper books, you don't have your corporate meetings, you don't keep corporate minutes, if something happens and they pierce the corporate veil, they'll come after you just as if that was a sole proprietorship. So if you're going to set your company up as a corporation, make sure that you're operating it as a corporation, that you have a board of directors, and that you're not the secretary, the treasurer, the vice president, and all of the above in just one person. So if you're going to do that, it's probably better to be a single member LLC, which is going to offer you much more protection than being incorporated. And if you incorporate yourself, you're going to be subject to double taxation. We'll come back with the full part in another week.